Good afternoon. We are Allain and Mikael Nagy, and today we will be presenting our investment thesis on Rocket Lab Corporation with the ticker symbol of RKLB.
The space economy is projected to grow substantially over the next decade, driven by satellite deployment, national security demand, and commercial space infrastructure. While SpaceX dominates headlines in the private market, we believe that Rocket Lab represents one of the most compelling publicly traded ways to gain exposure to the rocket industry's long-term growth.
Now, our current target price is $91, representing an approximately 35% upside from the $67.44 share price as of February 17, 2026.
We rate Rocket Lab a strong buy based on three primary pillars. First, a diversified, growth-focused business model. Second, strong operational execution and credibility. And third, an attractive valuation relative to long-term growth potential. Rocket Lab is not just a launch company. It is building an integrated space platform designed to capture value across multiple parts of the space value chain, an example of vertical integration.
Now, quickly, a few fun facts about Rocket Lab. Rocket Lab was founded in 2006 and is headquartered in Long Beach, California. In 2025, the company generated around $578 million in revenue, and it currently employs around 2,400 people globally.
The company operates in two main segments: launch services, primarily through its Electron rocket, and space systems, which includes satellite components, spacecraft platforms, solar cells, and mission integration. Importantly, space systems has grown into the majority of revenue. That shift reduces dependence on launch cadence and creates more recurring, contract-based revenue streams.
Now, our leadership system is one of the key ways in which we differentiate between our larger competitors. Our CEO, Sir Peter Beck, founded Rocket Lab in 2006 and continues to lead strategy, innovation, and engineering execution. Founder-led companies often outperform because long-term vision outweighs short-term quarterly pressures.
Next, a little bit more about leadership. CFO Adam Spice has provided financial discipline since 2018, while Chief Operating Officer Frank Klein brings over 30 years of operating experience from global manufacturing leaders. This combination of engineering vision and operational scaling expertise is critical as Rocket Lab transitions from a growth startup to a scaled aerospace manufacturer.
Now, quickly, a bit about geographics. The main amount of our demand for Rocket Lab comes from the United States, with 61.5% of revenue generating here. This anchors Rocket Lab in the largest and most well-funded space and defense market in the world.
On the other hand, Canada and other places in North America accounts for 24% of revenue, Japan 7%, and the remaining 7.5% comes from other global markets. This diversified exposure across allied nations reduces geopolitical concentration risks and aligns the company with governments increasing spending on space-based intelligence, communications, and defense infrastructure.
Now, Rocket Lab is still growing, and it currently trades at an approximately 12 times forward EV to sales ratio, which is the same thing as an EV to revenue ratio. While that appears elevated compared to mature defense contractors, this is because of our very high growth rate. Those companies typically grow at mid-single digits annually.
Rocket Lab has delivered roughly 40% 3-year revenue CAGR with expanding gross margins in the 25 to 30% range. While evaluating growth companies, valuation must be considered relative to future operating leverage. As scale increases, fixed manufacturing costs are spread across more launches and spacecraft production, improving margins over time.
Our DCF model, a discounted cash flow model, assumes continued revenue scaling, gradual operating margin expansion, and a terminal multiple consistent with a scaled aerospace growth platform, supporting our $91 intrinsic value.
Rocket Lab occupies a unique competitive position. Compared to Lockheed Martin or Northrop Grumman, Rocket Lab offers significantly higher growth exposure but an earlier profitability stage.
Now, compared to some of our smaller competitors, such as Firefly Aerospace or other small launch startups, Rocket Lab is far more diversified, generating substantial revenue from their space systems.
And compared to SpaceX, Rocket Lab is not trying to compete in heavy lift missions. Instead, it focuses on small launch and dedicated payload services, a niche that prioritizes flexibility and responsiveness. Electron is currently one of the most frequently launched rockets globally after SpaceX in China, demonstrating operational credibility.
The first driver is an expansion of the space systems segments. The first driver in expansion is the space systems segments. Our satellite platforms, components, and integration services are growing rapidly and typically carry very attractive margins.
Second, backlog exceeds $1 billion. Backlog is critical because it represents contracted future revenue, not speculative growth.
Third, rising launch cadence strengthens customer trust and reoccurring demand.
And fourth, Neutron. Neutron moves Rocket Lab into the medium lift category, dramatically increasing total addressable market. If executed successfully, this could be the inflection point for revenue acceleration beginning in 2027 and beyond.
Finally, global defense and intelligence demand continues to expand. Satellites are increasingly central to national security, missile tracking, and communications networks.
Next are moats. Rocket Lab's moat rests on vertical integration. The company manufactures engines, avionics structures, and spacecraft components in-house. This improves cost control and secures supply chain dependencies.
Second, approximately 57% of backlog comes from government consumers. Government contracts are often multi-year, high compliance, and relationship driven, creating a very reliable source of revenue.
Third, knowledge and trust. Rocket science has extremely technical barriers. A proven launch record builds credibility that is difficult to replicate. In aerospace, reliability compounds into competitive advantage.
Now, Rocket Lab not only is still growing, it also maintains an ESG score of approximately 77.6, based on industry-adjusted MSCI metrics.
The company emphasizes environmental responsibility through reusable launch technology and responsible orbital operations. Governance standards are reinforced by compliance requirements tied to government contracts.
Now, not all investments are perfect, and even Rocket Lab has its own faults. Our key risks include neutron execution risks, meaning that if all the R&D that went into the neutron rockets is made useless based on repeated failures, we would be losing lots of money. Now, profitability and cash burn are other risks, and other potential launch failures.
Additionally, competitive pressures from SpaceX and emerging providers could impact pricing power. However, we believe Rocket Lab's diversified model and proven track record mitigate these risks.
Now, our final conclusion. Rocket Lab is a vertically integrated founder-led aerospace platform positioned within a structurally expanding global industry.
With diversified revenue streams, strong backlog visibility, expanding margins, and long-term growth catalysts such as Neutron, we believe the company is undervalued relative to its 5 to 10 year potential. Our $91 price target reflects that conviction. Thank you very much.
Thank you.